This podcast is intended for investment professionals only. All investing involves risk.
Hello, and welcome to another episode of LGIM Talks. My name is Nick Jardine, and I'm the content manager for private markets in Legal & General's asset management division. We recently published our 2025 outlook for private markets, and I'm delighted to be able to welcome 4 members of our investment team today to discuss some of their areas of expertise in a little more detail. To kick things off, we've got Matteo Colombo, who leads across L&G's digital infrastructure investments. He's going to talk over what might be in store in the realm of digital infrastructure in 2025. Matteo, thanks so much for being here. I think a good place to start is probably some of the macroeconomic themes that have impacted all markets over the past few years. So how do you see the interest rate picture impacting digital infrastructure assets over the next 12 months?
Thanks, Nick. Great to be here and great to talk about digital infrastructure. It's a really exciting sector that is now probably the largest infrastructure subsector in the market in terms of investment activity. In particular, we're seeing significant investment activity in the data center space, driven by cloud growth continuing to grow at a strong 20% plus CAGR, and now AI growth growing somewhere between 30 and 40% CAGR. AI, in fact, is pretty much impacting 50% of data center demand. And with that, the sector has rallied and actually gone up in valuation over the last year or so, having maintained its valuation in difficult times with higher interest rates, higher inflation, costs from the Ukraine crisis, etc. What's really driven the sector is that for the first time in many years, prices have been able to be increased substantially. And that's because spare capacity in the sector that was built in cheaper times has now been utilized. So with that, pricing has gone up. The vacancy rates in turn have dropped to relative historic lows. In places like London, you're looking at low single digit 1%, 2%, 3% vacancy rates. So that's data centers. So fiber and towers are all relating to the transfer of the internet. And the thematics remain the same. However, the practicalities of investment performance and drivers slightly vary. On the fiber side, as you're all aware from looking out windows, traveling, there's a lot of disruption in cities as fiber networks are being built. Fiber networks being more nascent are more impacted by the build costs, and also being more nascent, the take-up is still on the rise. As such, with higher interest rates, financing, build costs, these businesses have been impacted more significantly. Add to that the competition. Again, just think at your home, you often have many suppliers you can buy fiber from, means that it's a tougher market. And as such, the valuation of these firms have dropped. However, in the last kind of 6 months or so, again, valuations have begun to pick up as the landscape has improved. Interest rates look like they are more stable and potentially over kind of medium term coming down. Also, competition is clearing out, and so the environment going forward looks more interesting.
Thanks, Matteo. So another big story of the past couple of years has been the advance of AI, and particularly generative AI. I wonder if you see this continuing through 2025, and if so, what the implications might be for digital infrastructure.
Yeah, no, thanks, Nick, for that question. It's a really exciting area and one that I do see continuing. AI, after all, is not a company, it's a technology. And all it is enhancing the compute mechanics and software around that. With that, chips are running more efficiently than they ever have. Chips are more powerful than they ever were. And so chips are more efficient. They're able to produce more, offer owners of those chips and products better yields. And with that is now filtering down into the infrastructure of the internet, and prices are going up. So with that, everyone is a winner. The customer is able to do more, make higher yield on their digital products thanks to the chips. Equally, the infrastructure providers are also seeing a tick up in prices. And I would say that prices have increased of the magnitude of about 30% in the last year. Our pipeline in terms of customers in the data center sector, again, roughly increasing somewhere between 30 and up to 50%. So I don't see that slowing down. Digital infrastructure is a medium to longer term infrastructure build. Takes roughly 3 to 5 years to build such infrastructure, potentially a little bit more if you include planning. And therefore, it's not like you can just resolve the supply-demand imbalance at the in a matter of very short time. And so for that reason, we see the growth continuing, the supply looking to catch up, and we're very focused, on helping enable the infrastructure for tomorrow.
Great. Thanks for your time, Matteo. Next up, we turn our attention to affordable housing. I'm very pleased to be joined by not one, but two of our investment team to talk about this subject. We've got Ali Farrell, Fund Manager, and Simon Century, Head of Capital Investing with us. Thanks both for taking the time. Perhaps the best place to start is to talk about the case for affordable housing, both as an investment and in terms of the overall need to increase the availability of it. With the next 12 months in mind, could you lay this out for us?
Sure, thanks, Nick. So there's probably three parts to this. It's probably worth just taking a little bit of a step back and looking back through history, and then we'll just maybe touch upon the reality of today, and then maybe just look forward to the opportunity. So from a historical perspective, social housing, or affordable housing as it's often termed, has been delivered, if we look back over the last 100, 150 years, by a mixture between local authorities or central government on the one hand, but more latterly, really over the last 30 years, predominantly by not-for-profit housing associations. What's really happened, though, over particularly the last 10 years or so, is that we've discovered that the level of affordable housing that has been delivered has been under severe pressure. The capacity of those not-for-profits has been much more limited in nature, and that's due to recent events, things like high interest rates, higher inflation. It's been because of things like the drive towards net zero, and it's been because of areas like fire safety, which have substantially increased the amount of financial pressure which exists on housing associations. So the reality we find ourselves in today is one which is in some ways quite bleak. To throw out some numbers, there are about 1.2 million households on social housing waiting lists today. They're in temporary accommodation terms, there's over 120,000 households currently on waiting lists. That's 159,000 children that don't have a place really to call home today, and don't really know where they'll be living from one week to the next. So the problem in some ways is vast. To put it differently, by most estimates, to really clear that backlog, we're looking at a systemic programme of new affordable housing delivery over the next 10 or 20 years, which needs to be in the region of 140 or 150,000 new homes a year. Sadly, we're delivering about 40 to 50,000 homes as a nation, and that's been the case really systematically for the previous 20 or 30 years as well. So we're in a pretty hard place to start with, but there is, I think, some light at the end of that tunnel. Really, over the last 4 or 5 years in particular, we're starting to see long-term investors that have a desire to make quite a large impact in the sector really start to come to the front of the drive to try and increase affordable housing at scale, whether that's insurers, whether that's local government pension schemes. We're now seeing them start to step up, and actually, really, over the last couple of years, we're seeing it somewhere between about a third and a half of new affordable housing delivery has come now actually from that institutional market of investors, rather than necessarily from the housing associations that have been the major deliverers of the last 30 or 40 years.
Thanks for that response. Any investment outlook over the past couple of years has talked about inflation and interest rates, and I guess we can't really get away from these subjects here either. What's the relationship like between inflation and the affordable housing sector, and how do you see this playing out over 2025?
Yeah, well, great. Well, I guess kind of connecting to what Simon has just been saying, affordable housing is an asset class, is inflation linked. So this provides the investors that have come into the sector with stable returns that are less sensitive really to macroeconomic indicators like inflation and other assets. Rents tend to be linked to CPI +1. This gives investors that certainty of cash flow, and it really brings the interest of new investors coming into the market and delivering that new affordable housing, whilst also delivering the returns that pension fund long-term capital requires. I think what's really interesting is that affordable housing can act as protection from kind of the cyclical nature of other real estate products. So it acts more like a long-term inflation product rather than a standard real estate product. And we're finding that has been a real appeal at the moment. And that's kind of the ability to get more capital coming into the sector because it looks slightly different than some of our more traditional sectors.
Thanks. Affordable housing is often presented as an asset class that has the potential to provide sustainable returns and stable long-term income alongside real-world impact. Can you maybe explain a little bit about why this is the case and why in the prevailing investment environment this is something that could be potentially attractive to institutional investors?
Yeah, so I guess building on top of that, we have talked about the benefit of the inflation-linked income to investors, and that really is kind of Pillar A that's really interesting as part of this sector. Pillar B is about the social impact, the real world impact that you just mentioned, Nick, that it makes. So the investment in this product, what impact that makes for the investors themselves. So affordable housing and an investment into any affordable housing means developing new homes for the families that Simon mentioned that are waiting on these housing waiting lists. It also develops homes that are actually affordable. So particularly the development of new affordable housing stock into the market delivers not only new homes that are affordable, but also proper homes that are cheap to run. So they're highly energy efficient. They have got very high EPC ratings, very high credentials. And what that means for the individual, the actual family living in that home is that they can afford to rent it, but they can also afford to heat it, which is a really important part of the strategy as a whole, but an important part of why investors invest into affordable housing. I'd probably just add slightly on top of that we've seen really strong interest from a number of different investment pools, but local government investors are particularly looking at this sector at the moment. And the appeal of that is where they can actually invest pension fund money into their local area or into homes where they can see direct beneficiaries from that investment. So that's why it's becoming a really interesting product in 2025.
Thank you. When we talk about affordable housing as an asset class, we often speak about how it's impacted by regulation and by demographic changes. What role do you see these factors playing over the next year?
Thanks, Nick. Maybe start with the demographic question to begin with. In some ways, actually, demographic shifts and population growth are somewhat secondary because, again, we go back to the beginning of this story, which is there are 1.2 million households on waiting lists. So, irrespective of how bad it goes from here, actually, there's a colossal amount of work that needs to be done just to catch up with the fundamental lack of new build supply over the previous 30 years or so. But going forward, in some ways, the size of population growth that we've been experiencing as a country for many decades and likely to continue for a long way going forward only increases to the size of the I guess the gap we're trying to fill here. So that is undoubtedly going to be increasing the pressure and also increasing, I guess, the opportunity for further investment to come into the sector at a very large scale. Regulation you touched upon there, which is really interesting. So this is a sector which has been actually really well regulated by what's called the regulator of social housing. They've had various names over the last 20 years or so. But essentially what they do is they look at a number of different areas in the sector. To be a holder of social housing or affordable housing stock, you have to be what's called a registered provider of social housing. That means you have to be regulated as such. But the way the regulation works is by a series of both ongoing monitoring from the regulator, but also essentially looks at each and every provider through three main lenses. One is financial, making sure they are financially viable and robust for many, many years to come. Second, from a governance perspective, this is a sector where I guess governance standards are extremely high on the whole, and they are that is absolutely ensured by the regulator. And the third part is actually from a consumer perspective. They're making sure both customers, both tenants, as well as the assets that any registered provider holds are also held and looked after to the right standards as well. So regulation is an absolutely part of the sector, and it's one that actually on the whole I think most if not all players in the sector absolutely welcome, and it's a very, very good thing. The final thing I'll say is just maybe that the step back and how we look at the sector as a whole. So what's undoubtedly been true is that housing as a whole, not just social housing, has been somewhat of the unloved child in many ways when you think about where sort of global capital has been focused for quite a long period of time, or actually the way that often local or central government thinks about it as well. What's been great to see, I think, over recent years, and particularly over the last year or so, is that actually housing as thought of, I guess, increasingly has been quite different, particularly social housing. And to bring it to life, when you think about a school that needs to be built, you need to have teachers that live in and around that local area. If you think about a hospital, you need to have the cleaners, the nurses, the doctors that live in the area as well. So when we think about real world national planning or local planning as to what the way in which this country needs to get built from here on in, for me, the heart and soul of that is thinking about housing as part of as part of national infrastructure. It goes to actually the fabric of actually how we want the society to take place.
Excellent. Well, Ali, Simon, thank you so much for your time today. Finally, Chris Hopkins, Head of Venture Capital, is with us. Chris, thanks enormously for being here. One area I know you spoke a lot about over the last year is the UK university spinout sector. I know this is an area that has grown in recent years into a genuine institutional asset class. Perhaps we can start by looking at how you think the sector will continue to develop in 2025.
Thank you. Yes, well, we are very excited about what's going to happen in 2025 and beyond with the UK university spin-out sector. We think we're going to see continued growth. Why do I say that? Because there is an increased recognition that there is now a funding model around getting and investing in spin-outs coming out of our leading universities such as Oxford, Cambridge, Imperial College London, University College London and Manchester. And more capital is entering those investment platforms, a number of which we've been invested in for nearly 10 years now. And further capital is then coming in at the later stages as these companies seek to grow. And when I say later stages, this is when these companies have been spun out and have got to around commercial stage where they'll have some early contracts, some revenue, but haven't really got that sort of inflection point of double-digit million revenues that then becomes more interesting to more traditional investors. And we see that as a real opportunity, a sort of a valuation arbitrage to invest and make really interesting venture capital style returns from.
Thanks, Chris. So from a technology standpoint, AI has dominated the headlines over the past couple of years, and that's something I think many people see continuing over the next 12 months. But it's not the only cutting-edge technology that's out there. Perhaps you could talk a little bit about some of the innovation you're seeing in the spin-out space that might capture some attention in 2025.
Yes, well, I mean, firstly, I should say, AI, artificial intelligence is a really huge area. I mean, it is a real it's the next major global technological platform, which a huge amount of innovation will derive from for many years to come. And, it's an area we are particularly excited about. Now, of course, there are other areas as well, but I just don't want anyone to think that we aren't incredibly excited about it. In terms of other areas, and, maybe just I'll touch on some of the applications around AI to make it a bit more specific, but clearly there's a lot going on, particularly around quantum computing. There's some real clusters of companies around some of our leading universities, and whilst it's not clear which sort of technological solution will win through, a bit like the same with nuclear fusion, where we've got a number of really interesting and slightly different approaches to nuclear fusion. We like companies that are taking a platform approach, sitting on top of that, of these new technological developments in, for instance, quantum computing. So we've recently invested in a company called PQ Shield, which is a post-quantum cryptography business spun out of the University of Oxford, which is focused on protecting or creating a new cryptographic architecture for a world in which
quantum computers are ubiquitous. And why is that important and essential? It's because quantum computers will be able to crack every known password on the internet, and they are coming sooner than we think. And so there needs to be a new cryptographic framework, global cryptographic framework and standards to protect against that. And PQ Shield are one of the few companies out there that have the capabilities to do that. So that's one example. There are others, obviously, in healthcare, and obviously I was sort of talking about some applications around artificial intelligence, particularly in healthcare on the diagnostic side. We think there's a huge amount of potential, which we're already seeing. There's a company at the moment we're looking at in the heart failure space, which is using AI to more than double the rate of detections of this particular type of heart failure. And that's now recognized in the broader healthcare ecosystem in the US. They're looking at they've already got their reimbursement codes. So there's lots of incredibly interesting things going on. AI is a big driver, huge platform of which a number of things will be taken off.
Lastly, to return to university spinouts, it's notable that you single out the UK when we're talking about this sector. Can you go into a bit more detail about what it is about the UK that lends itself to an attractive spinout sector?
Well, I think you need to start with our science base and our research base, which is truly world-class. I spent a number of years in the UK government and was lucky enough to get a real sense for what the UK was good at across our sectors. And the sort of, our UK science and research, it always came back to that being something we were really exceptional at. So that's a good foundation layer to start from with any, investment idea or strategy. And I think, building on that, the way our universities are funded in the UK with a lot comes from the public purse. Most of our UK universities are publicly funded rather than privately funded, which is a big difference with a lot of the Ivy League universities in the US, which means that they, and for a number of other reasons as well, the UK universities tend to own a lot, if not most, of the intellectual property created within them in their research departments. And so that has that held back, I think, the UK commercializing a lot of its research coming out from its universities in the past. But in the last 10 years, we've seen these new investment platforms being set up around these top research universities, which have enabled long-term patient capital to go into these companies that is required to get them to a stage where they can attract more traditional types of sort of venture capital finance. And so I think that's certainly one area or a couple of areas that make it quite unique.
Great. Chris, thanks so much for your time today.
Thank you.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal & General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal & General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.